Hi, I'm Brad Case, Homes.com's chief residential economist, with one thing you should know about the homes market. This week, it's higher for longer interest rates. Investor behavior right now suggests that the Fed is more likely to raise its policy rate over the next year rather than to cut it, by a quarter point this fall and maybe another quarter point next spring. That comes as this week's inflation report showed prices 4.2% higher than they were a year ago as of May. That makes it hard for the Fed to justify cutting rates, but at the same time, the employment market remains solid too. Employers are still adding jobs, and wage pressures haven't gone away. So high inflation would already make it hard for the Fed to cut rates, but that's especially true when the jobs market remains strong too. And yet the homes market remains resilient. The number of home sales in May came in stronger than expected, with a notable uptick among first-time buyers. That tells us demand is still there, even at today's elevated borrowing costs. Now, mortgage rates don't move in lockstep with the Fed, but they do respond to the same underlying drivers, especially inflation and the strength of the jobs market, but also expectations about future Fed policy moves. When all of those are pointing toward higher for longer interest rates, mortgage rates will tend to stay elevated too. The takeaway is that mortgage rate relief is likely to be gradual at best. But instead of waiting for mortgage rates to drop, the market is adjusting to a new situation where borrowing costs remain elevated, but home buying activity continues. That helps explain why buyers are stepping in, especially first-timers, rather than waiting. I hope that's helpful. For Homes.com, I'm Brad Case.